Good afternoon, everybody. A lot of people have been focusing on gold lately on our site, so maybe that's a warning signal. I don't know. But I thought I'd come back. I do keep an eye on gold, and I do think this is an exciting time for it. But what I wanted to talk about today, aside from maybe some of the technicals in gold, I wanted to focus on the intermarket aspects of it. Because gold, gold is a store of value, but it really doesn't have any fundamentals to it. It's hard to tell what it's worth. I think more than any other market, gold is influenced by other markets. So I want to focus on that today. We're going to start with the dollar. Probably one of the best known intermarket relationships is the relationship between the dollar and gold. Since gold is priced in dollars, generally speaking, they trend in opposite directions. So this chart one here, let me just explain what it is. It's a very simple chart. The brown bars there, that's simply the price of gold. I'm using bullion here. This is the cash value of gold, and these are monthly bars. And the green bars that you see there, that is the dollar index. It's the cash index. And obviously, what jumps out at you is that they generally move in the opposite direction, and that's really the whole point of this chart. And just to give you a couple of examples of that, to the left of the chart. If you go back to, say, 2011, you notice that began a nice uptrend in the price of gold, the dollar, which lasted for 4 or 5 years. And notice that coincided exactly with the downturn in the gold market. That is normally what happens when you get a strong dollar. The price of gold normally weakens, and that's exactly what happened. If you move a little bit further forward to, let's say, to the end of 2015, you'll notice that we had a little rally in the dollar there. Gold pulled back a little bit. Gold actually hit bottom at the end of 2015 and had a very strong 2016. We had a little pullback in the dollar. The dollar actually rallied until the end of 2016. If you can see that last bar up there, the end of 2016. And that's really when, in my opinion, the dollar started to peak. We had a very weak 2017. Notice a drop in the dollar during 2017. Notice we had a little rebound in the gold market. The dollar rallied during 2018. Gold pulled back a little bit. That green arrow to the upper right there simply shows that this latest rally in the dollar that started last year didn't quite reach the highs of 2017. So this is the first sign that this uptrend in the dollar may be fading a little bit. Of course, this is a long-term chart, but other writers have shown, if you look at a daily chart of the dollar index over the last month or so, it has started to weaken. It's trading at the lowest level, something like 4 to 6 months. So if the dollar is peaking here and is starting to weaken, that would be a positive sign for the gold market. In fact, of all the intermarket relationships that we all write about, the most consistent and the most easily understood is the dollar and gold. So if the dollar does start to weaken from here, that would be good for gold. Now, if you look at the gold chart itself, those are price bars. You can see that the price of gold, as I mentioned, it bottomed in 2016. It's been basically moving sideways since then in what looks to me like a major bottoming pattern. I simply draw a trend line over the highs of the last, whatever that is, 5 years, starting in 2014. To put a name on that, I think that's a neckline. I think this is sort of, I hate to put names on patterns, but sort of like a complex head and shoulders pattern, if you want to call it that. But it looks to me like the market is trying to bottom. We've had a pattern of rising troughs over the last 3 or 4 years. But every time we've touched that neckline, we've backed off. I think we're getting very, very close to the point where I think we may be getting close to an upside breakout. I don't know what, we are in the process of testing that line right now. As you can see, we've actually touched that line. So we're watching this very, very closely. And as I mentioned, there are a lot of intermarket factors working in the favor of gold. And we've already talked about the dollar. Now, one of the things that's influencing the dollar is the direction of interest rates. And that interest rates also have a tremendous impact on the direction of gold. This maybe isn't as well known as far as intermarket factors are concerned, but it is something that I watch very closely. So, Erwin, if we can go to chart 2, we can see here, what we're doing here is we're comparing gold to the direction of the 10-year Treasury yield. And the basic rule is still the same. They generally trend in opposite directions. Again, these are monthly bars also. And again, we'll start at the left side of the chart in 2007. You can see we had a sharp downturn in bond yields. Gold rallied very sharply. Now, 2007, there were a lot of other things going on, even though we're looking at these one at a time. The reason the bond yields fell so sharply during 2007 was because stocks fell very sharply, and we had a huge flight to safety into Treasury bonds. So that pushed Treasury yields sharply lower. Also, the dollar fell very sharply during 2007. So there were other things going on, but still, you can see that a sharp drop in yields boosted gold. Now, bear in mind, one of the reasons gold is so interest rate sensitive is because it's a non-yielding asset. Gold does not pay any interest. If you own gold, you get no interest on it, and you don't get any dividends from the price of gold. So it's a totally non-yielding asset. As a result, when yields are rising, gold falls out of favor. There's no reason to buy gold if you're looking for yield. If you can get yield in other markets, if rates are rising and you can get higher yields here, there's no reason to buy gold. When rates are falling, however, and the yield is very low, this greatly increases the interest in gold, and that's why that is. So we saw that sharp drop in bond yields, 2007, gold, and then for the next 5 years until about 2012, you could see almost a perfect inverse relationship between the two. It's very obvious. Now, if you go to 2012, that green up arrow, that bond yield started to bottom. 2012 had a nice rally, 213. If you look at the upper part of the chart, that's exactly when gold peaked. So it's very clear, once again, when rates are rising, that diminishes the appeal of gold, and gold has been falling since then. Now, over the last, since about 214, you'll notice they've been basically moving sideways in opposite directions, but basically moving sideways. Every time bonds have dropped, for example, 215 there, I have a green arrow, green down arrow. Notice we had a drop in yields. We had a little bounce in gold. Then we had a little rally in yields from 2018, a little pullback. So they're moving in opposite directions, but in a trading range. But that circle to the right there, I think that's something that's really what's driving it now. Remember, this is a 10-year yield, has fallen very sharply. In fact, it has really shocked most of us how sharply bond yields have fallen. The 10-year yield has fallen to the lowest level in 20 months since, I think, September of 2017. And part of the reason for that, of course, is some signs of economic weakness, tariff problems, but also expectations for maybe a Fed rate cut. But bond yields are dropping, and normally, and you can say it's not as dramatic, but if you look at the brown bars, you'll notice that since the peak in bond yields at the end of last year, gold has been moving up. Not a lot, but it is starting to move up a bit. So if rates continue low, and if I would suspect if the Fed does lower rates either 1 or 2 times this year, I think that would increase the appeal toward gold. And by the way, if the Fed does lower interest rates this year, that should weaken the dollar. So gold will get a benefit from not just falling bond yields, but also, I think, from a falling dollar. We have the highest rates in the world among developed countries. We're the only one that really has any room to ease. In Europe, most rates are negative. In Japan, they're negative. They really don't have much room to ease. We are the only central bank. We're over 2%. We have a little room to ease, and I think that those expectations are one of the factors that are driving the dollar lower, yields lower, and I think should start driving more money into the gold market. So far we've talked about the dollar, we've talked about interest rates, and of course they're linked. But there's a third element that impacts the direction of Aaron, you're right ahead of me there. There you go. Gold versus the stock market. There it is. Gold is very much impacted by the stock market. So I went back just to demonstrate this. I wanted to go back, show a little history, because you can actually see this. This chart here is it's a very simple chart. The black bars there, normally when we compare gold to the stock market, most people use the Dow. It's just a sort of a tradition, so I'm kind of sticking to that. The black bars these are monthly bars. That is a Dow Jones Industrial Average. This is a log scale, by the way. I did that because it shows up a little better. Going back to 1990. I could have gone back to 1980 and show the same thing, but it's just too much data. And the basic point, and the brown line there is a ratio of the gold market divided by the Dow Industrial. So obviously it tells us what gold is doing relative to the stock market. And you can see the basic rule of thumb is that they trend in opposite directions. If you look to the left of the chart, let's say between 1990 and 2000, we had a very strong stock market, as you know. In fact, it was up almost 10 years in a row. During that period of time, gold underperformed stocks by a wide margin, and that's the falling ratio. It was very, very obvious. What really started to change was during 2000 and 2001. If you remember back, that's when the stock market peaked. We had the dot-com bubble bursting, and stock market went into a bear market from 2000 to the end of 2002. If you look at to the bottom of the chart, that was the exact point where gold started to come back into favor, and that's normally what happens when stocks are doing well. There's no interest in gold. When stocks start to stumble or go into a bear market, or people start to get nervous, they start looking for safe havens, and gold is one of the top choices. So you'll notice, in fact, stocks traded sideways. It's not as obvious on this chart. The S&P probably would have been a better choice. But anyway, the stock market traded sideways for almost 10 years, from the beginning of 2000, let's say, to the beginning of 2000, actually to almost 2010. And that has been referred to as a lost decade. It qualifies as a secular bear market. Stocks traded sideways for almost 10 years, with two very big bear markets in there. The big one, of course, being 2007, 2008. During that entire decade of weak stock prices, look at that gold Dow ratio. Gold was the place to be during those 10 years. Gold outperformed stocks by a very, very wide margin. Now, interestingly, gold stocks turned up at that black arrow there. I just wanted to point out that gold stocks did turn up in 2009, but you notice gold did not peak until 2011. That's the brown arrow there. I just wanted to explain. Normally, you would expect stocks of gold to turn down right away. There were two reasons why gold was a little behind stocks there. One was that we had a plunge in the U.S. dollar during 2010 and 2011, so that supported gold prices. But also, even during 2009, 2010, while the stock market was rallying, there was still some debate as to whether this was the beginning of a major new up leg, or if it was just a continuation of the decade-long sideways trend. It wasn't until 2013, and I don't have it marked off there, but Erin has the thing right on it. 2013, stocks hit a record high. That took place in 2013, and that was when the gold market really started to tumble. So again, a new high, secular bull market starting in stocks, gold underperforming. And as you can see, that ratio, stocks have done very well since then. And as you can see, the ratio was falling. So between 2011 and 2018, there was just no reason to be in the gold market. Now, that's history, and I just wanted to establish that this inverse relationship goes back. I could go back to the 1940s and show this to you, but I think this just establishes the point that what the stock market does influences the price of gold. Now, let's focus in on the last year, and this is when it starts to get a little more interesting. This chart here is the chart along the bottom there is, there you go. That is, I'm just comparing gold to the Dow Industrials over the last year. Okay, and it's a very simple chart. The brown bars there, we're looking at the lower box there. The brown bars are simply as a daily chart, I believe. Yes, it's just the price of gold, bullion, and the gray area there represents the Dow Industrials. And the point of this chart is that every time stocks have stumbled, money has flowed into gold. And that first black arrow there, you can see last October when the stock market started rolling over and had a terrible fourth quarter. That's when gold turned up. which is normally what happens. Then, in fact, if you look to the upper chart, the upper box there, again, the gold Dow ratio, you can see it bottomed in October. It rallied all throughout the fourth quarter as money coming out of stocks. A lot of it went into bonds, but some of it went into gold. Now, the ratio peaked. This is all as it should be. The ratio peaked in January. You can see that the brown arrow there on the top. And has been basically falling. Yeah, there you go, Aaron. The arrow there peaked, which meant that in the beginning of this year, as the market rallied again, the gold stock ratio started falling. There you go. Now, gold didn't actually peak until February. I'm not quite sure why it was a month late, but anyway, you can see that it rallied. But from February until, let's say, about a month ago, gold was very much out of favor. Gold stocks were very strong. Stocks, in fact, some of them were hitting new highs. The Dow didn't quite reach a new high, but very, very close. But it was only over the last month, about a month ago, a little over a month ago, when trade tensions started to escalate, as you all remember, with China and then Mexico. Stocks had a very bad month of May. That green arrow, the black arrow there, you can see. And once again, and so we had a very bad month of May, and a lot of people were concerned. But look at that gold, right on cue, gold just turned right up. And you can see the price, the brown bars there, the price of gold has rallied right up to its February high. Now that's a very, very, and as you can see, the gold ratio also. But that's a very, very important test. Bear in mind that we are up against major resistance, that major long-term neckline. This is a very, very important test. So we'll have to see what happens from here. But the only point I wanted to establish here is that aside from the dollar, in addition to the dollar, in addition to interest rates, what the stock market does is has a major influence on the direction of gold prices. And every time the stock market sells off, money flows into gold. Okay. So that's that. And I just want, that's important. So those are the three main things that I look at. And bear in mind, is just before we leave this chart, I just want to say this, that, we are in the 10th year of this bull market. No bull market in history has ever lasted this long. I don't want to sound too fundamental here, but we have to know about these things. There are signs of weakness in the global economy. Europe is weak. Japan is weak. China is weakening. Which is one of the reasons interest rates are so weak. And we are, as I mentioned, the oldest bull market in history. There are potential trade wars. So if you look at what's going on within the market over the last 6 months, we've seen money flowing into safe havens. Gold is a good example. In currencies, the Japanese yen has been very strong. In fact, there's a historical correlation between the yen and gold. And yen, in fact, has been one of the strongest currencies in the world over the last several months. So we're seeing money flowing in there, the Swiss franc. In the U.S. market, we're seeing people buying treasury bonds. Normally, another way of saying interest rates are negatively correlated to gold is that gold and bonds generally trend in the same direction. But also we're seeing money flowing into consumer staples, utilities, REITs, defensive groups. I suspect that investors are not turning negative at this point, but they are starting to hedge their bets about a very old bull market, signs of weakening. They're not abandoning the stock market, but I think they are taking out a lot of defensive protection, moving into defensive sectors of the market. They're moving into bonds, treasury bonds in particular. But gold is certainly one of the markets that they are moving into. Not just gold, but gold stocks also doing quite well. So having said that, let's move down to our last chart, which is gold may be nearing upside breakout. Now this was written yesterday late morning, I think. When I'm looking at what gold is doing during the course of the day, you can't look at bullion itself because that's a day old. I use GLD, which is the gold share spider, which is an ETF based on the price of gold. It looks exactly like gold. It's just that if you're trading very short term, this is really what you have to look at. And all I'm showing here is since the beginning of 2018, and the headline is right there, gold spider may be nearing upside breakout. You can see, by the way, that thing turned up August, October, actually really in October during the fourth quarter when the stock sold off. We rallied into February. And by the way, notice that blue circle there, that is the golden cross, appropriately named in this case. The 50-day moving average, the blue line, went above the 200-day. That's normally a very bullish sign for chartists. The 50-day remains well above the 200-day. They're both rising, and the GLD remains well above it. So moving average trends. Now that line that I have drawn in there is just to show that not only are we testing the highs that were set earlier this year, but we're very close to challenge. This line can be drawn in different ways, but I just wanted to make the case that in chart one, we showed a neckline going back about 5 or 6 years. So we are also in the vicinity of testing that. So those of us who follow charts know that if we were to get a decisive, and I mean a decisive move well above that February high, that would be a very bullish sign for the price of gold. I'm not predicting it's going to happen, although I suspect it will sometime in the, if not this week or next month. I suspect sometime maybe before this year is out, we're going to see this happen. We're at that point we're in a very mature economic cycle, which is starting to slow. This is that time when people start moving their money into gold. So I just wanted to point that out. And I'm also in the process of writing an article, which I'm going to probably publish later this afternoon, which I just want to mention that. I'm also writing an article on gold stocks, the gold mining index, which is GDX. And the reason I'm showing that is that there's a fourth element to this intermarket in addition to the three that we've already talked about, and that is the relationship between gold mining stocks and the commodity itself. Now, for obvious reasons, they do trend in the same direction. I mean, that much is obvious. And gold mining stocks have also been rallying quite sharply over the last month. I don't have a chart to show you, but I'll have one on there by this afternoon. And so if we do get a breakout in gold, we would want to see gold mining stocks break out as well. You obviously, if we were to go into an uptrend here, and I'm still hedging, you know, I think it's going to happen, but it hasn't happened yet. We would want to see both break out to the upside, but there's just a little bit more to it. That one of the things I will show later today is that gold mining stocks have actually been rising faster than the commodity. In fact, that has been the case since last autumn. And historically, gold stocks are more leveraged than the commodity. When gold is weak, gold stocks underperform. One of the bullish signs for gold is when gold miners actually start to rise faster. It seems a little counterintuitive, but gold stocks, the point is that gold stocks generally do better than the commodity when gold is maybe in the early stages of an uptrend, and we are beginning to see that. So, but I'll hold off on that until later this afternoon. But that's something else to look at. So I know a lot of other analysts have been writing about it, and I agree with everything I've been looking at. It looks like it's time for gold to do better. But the point that I wanted to make today was that there are a lot of other intermarket influences that are affecting gold as well.
Excellent.
So gold is a big story. So Erin, that's all I have, and I'll turn it back to you.
All right. Well, you know, we have questions, of course. One of the ones, and we actually sort of touched on this one before the show, is, you know, what are your thoughts on gold versus, you know, the other metals like silver? Do they react the same as gold to the market? I mean,
no, they really, well, at the moment they're not, Erin. And this is you would think the commodities would trend in the same direction, and they normally do, but in this case they're not for different reasons. Silver, for example, has been rising a little bit, but not as much as gold. Silver is there you go. Did you have this planned, Erin?
Of course.
I'm very impressed. You can see that gold, silver looks like it's basing also, but not nearly as well. Silver is about half precious metal and half industrial metal. So the industrial metal portion of it is boosting it a little bit. But as you know, industrial metals have done very badly of late. Copper is down like 10%. That whole industrial complex, aluminum prices, steel, whatever, and they're all tied to China and tariffs and all this kind of stuff. So industrial metals are not doing well. And silver, and so at this particular point, that's one of the fact that they're not doing well hint at economic slowing, which is one of the reasons that money is flowing into gold. So at this particular point, gold should do a lot better than the other metals. And by the way, I really don't look at individual gold shares much anymore. I do look at Newmont. Was it Newmont Gold Corp now? What is it?
Yeah, I think so.
Yeah,
NM.
yeah. Because that only because that's in the Newmont Gold. Yeah, I got it right. Uh, Only because that's in the it's in the S&P 500. In fact, I pointed out a couple of weeks ago that it was the strongest stock in the S&P. Yeah, here you go. This is one of the biggest stocks of the gold stocks. And I just said I don't look at individual stocks, but here we go. And you can see that you forced me into this, Aaron.
That's right.
This stock is right. It actually looks just like the price of gold, and as you can see, it's right up against its highs, right around 35. It's right there. So this is, and by the way, basic materials have been quite strong over the last month. The strongest part of that are gold stocks. I don't know if people are aware of that, but so money is pouring into this particular stock. It's in the S&P 500. It may be the biggest stock in the gold group, but as you can see, it's very, very close to an upside breakout. And obviously, and by the way, if you look at that last line from May, that big jump, I just pointed out that when gold is looking better, the gold stocks usually rise faster. That's a perfect example of it. I would suspect that has gone up fast. In fact, I know it has. It's gone up faster than the price of gold. So if you were to get a breakout here in Newmont, now it looks like we're pretty close. That would be a very good sign for the stock, obviously. It would be a good sign for the gold mining group. It would be a very good sign for the gold market. So sometimes it does pay to look at individual stocks, especially big ones like this. But everywhere we look, and notice the moving average lines are in bullish mode. So the stars seem to be aligning up in favor of gold at this point.
Excellent. So one of the other questions, and I'm going to pull up a chart just because it probably makes sense too, is do you ever look at GDX versus the junior gold miners, GDXJ?
Not really. Not really. Versus the junior gold miners.
Mm-hmm.
Actually, I'm a little surprised at this chart. I would thought that it would have been I would have thought that. I always think of I don't look at them that much, but I have in the past. I always think of the junior gold miners as being a little more speculative,
Mm-hmm.
like small cap stocks. And they always, in my view, they always seem to lead on the upside and lead on the downside. So I would have guessed, I shouldn't say this, but I should have guessed that the junior ones would have been doing better, but obviously I'm wrong. So in this case, the big ones are doing better. But no, I don't pay much attention to the junior ones. I kind of stick with the big stocks. By the way, Aaron, as long as you have that chart, could you put up the GDX versus GLD as long as you have it right there?
Of course.
This is one of the charts I'm going to be showing later today, so I'll give you a heads up. This is the GDX, which is the gold mining index, versus the price of gold. Notice last September, gold stocks started doing better. Bear in mind, the rule of thumb is that when gold is strong, they both rise together, but the gold miners do better. So this ratio should be rising. And you notice that's exactly what happened. Then we pulled back. But since the beginning of May, when all the trade problems with China and Mexico and everything else, notice they both, gold has done well. We've already looked at the gold spider. But notice that ratio is rising. That's telling us that over the last month, they're both rising, but gold stocks are rising faster than the price of gold. This is what we should be seeing if the price of gold is starting to move higher. So that's a very, very nice chart, and it kind of fits into what we're already talking about. So this is, now we want to see some upside breakouts here, obviously. But again, this is again, the fourth factor, the fact that gold mining stocks are starting to outperform the commodity is another positive sign for gold.
Thank you so much for coming on the program. It's such a treat.
I look forward to seeing you guys next month.
Yes, it'll be great.
Both Aaron and Mary Ellen. You guys do a great job.
Oh, well, thank you so much.
Missed a live show? Want to rewatch a workshop? Tune into the Stock Charts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have chart school and creative strategy videos to help you become a better technical trader. leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.